let's talk about remaining functions that you're going to see when you're purchasing a stock. What you're often going to see is these three terms right here: a stop loss, a stop limit, and a trailing stop loss. What do these mean? And do we need to use them? Spoiler alert, we don't need to use any of them, but we're going to go over them quickly just so you understand them. A stop loss is simply setting a price to initiate an automatic market sell. That is, if the stock drops to a certain price, our broker will automatically sell it. A stop limit is the same thing, except with a limit sell. That means we set the stop limit price, so that's going to initiate a limit sell when it hits that certain price at the set limit price that we put. And finally, a trailing stop loss is to have the price to sell to go up with the stock. That means when the stock price goes up, that bottom bound that's going to initiate the automatic sell, that goes up too. And you can either choose to make it go up in a percentage base with the stock price or a fixed amount. Now, like I said at the beginning of the video, do we use them? Nope, we don't even need to worry about it. These are good tools to use, but for the type of investing we're going to be doing, value, long-term investing, they are not necessary. Remember, we are value investors, meaning we are buying companies and we expect the value of that company to go up in the long term. So if stock price goes down, we don't worry. We know it's just a temporary dip, and because we know the value will go up eventually, which is why we purchased the company, we're going to hold steady. We don't sell because the price goes down. This is how people lose in the market. If you start selling as soon as the price starts dropping, you're following the trend, it's going to continue to go down, and you're going to lose money. Don't let your emotions take over. That's all I got for you guys today. See you guys next time, and don't forget to subscribe for daily videos.